Matt, we were talking this morning, and I wanted to talk about Tackle 25, one of your favorite systems. One of the most important things that we do at Tackle Trading is talk about cash flow and covered calls and investing. And this one is a perfect conversation for right now. What I want to do here today is go through each of the stocks on the Tackle 25 and give kind of like a mid-year report card,
Yep.
an update, talk about how and why we pick them and how we build it and whatnot. Before we do that, though, give any new listener out there a quick rundown. What is the Tackle 25?
The Tackle 25 is the Tackle Trading Growth and Cash Flow list. I believe the first list we put out there was in 2015. So this is our fourth edition of the Tackle 25. And basically what we wanted to do is it's a watch list. It's not a bias stock list. That's not what this is. It's not the IBD Top 50. It's not just based on growth. It's based on cash flow, covered calls, naked puts, credit spreads. It's a cash flow watch list is basically what it is. But for the most part, how we use it is covered calls. It's really called the Tackle 25 covered call system is what it's really called. And what we wanted to do is we wanted to put a list out of the best 25 covered call stocks. Now, when we say the best, we mean the best from a diversification perspective. So I know I can go do 25 tech stocks and usually get a bigger ROI, and 25 basic material stocks and usually get a better ROI. But it's very important for us to have different representations from different sectors on the list, just in case somebody needs to go get a utility stock, for example. But this is a combination cash flow and growth stock. Now, to be on the list, it goes through a very rigorous type thing, where you and me, Tim, and our researchers, we spend December researching the current list, deciding which ones to remove from the list. Has volatility changed? Has the fundamentals changed? Has the technicals changed enough? We're not going to pull a stock from the list just because it might be bearish downtrending. That's not what we'll do. But we'll pull a stock from the list at the end of the year if basically the fundamentals have changed in that stock, if the very reason we put that stock on the list in the first place has changed, if the volatility has changed, if we're not getting the credit on the covered call. For example, if on Walmart, for example, we would have Walmart on this list. There's no doubt about that. Walmart's a defensive stock. It's a cheap food-based company. It pays a dividend. It usually does decent in tough economic conditions, but you're only getting 1.1% on the covered call. So you can't add that stock to the list because the very reason that stock's on the list is for the covered call. So because the volatility changed, you have to be able to make modifications and changes and so on and so forth. And so we go through about 10 different criterias: PE ratios, PEG ratios, debt to income ratios, growth ratios. There's volatility conditions, there's technical conditions, there's volume. It is volume not only on the equity, but especially on the actual stock. It was important for us this year to make sure that the stocks on the list had weekly options. We looked at some fairly decent potential covered call stocks last year that we just didn't put on the list because they didn't have weekly options. That allows us better management techniques and so on and so forth. So there's a lot that goes onto the list. You don't need to understand why we put the stock on the list. You just need to understand that, this is a growth and a cash flow list. And if you look at the Tackle 25 from 2017, Tim, had a pretty decent year. The market had a really good year last year. The market went up about 20% last year in the S&P 500. The Tackle 25 went up on average 24%. So the Tackle 25 on average outperformed by about 4% against the marketplace. 72% of the stocks showed a profit last year on the list from a growth perspective. The worst performing stock on the list last year was AMD, Advanced Micro Devices. It went down 15% last year. But you know what? The covered call was generating over 3% a month, every single month on AMD last year, which means you could have cash flow between 30 and 36%. So even if you lost 15% on growth, you still cash flowed more than what you lost on the growth. And if you add that into the equation, no, not one stock on the list actually showed a loss last year. The best performing stock from a growth perspective was actually a real estate company called D.H. Horton. Alibaba was on the list, and D.H. Horton went up, I think, 92% last year. Baba went up 88% last year. And that doesn't mean if you would have bought them, you would have made that because you're writing the covered call. But that shows you have good growth plus cash flow on the list. And so what we wanted to do is we wanted to do a little mid-year report card. We're never going to remove a stock from the list during the year unless that stock does something like Enron does, where it just,
or if it got bought out or something like
or
that.
if it got bought out
There
or
could
something.
be reasons,
Yeah, there's reasons, but
but we
what we're
wouldn't
not going
replace
to
it
do,
with something.
Tim, we're not going to do what the S&P 500 does, and we're not going to do what financial advisors do in mutual funds and basically remove an underperforming stock to add a performing stock to make our numbers look better. We're not going to do that. That's
We're not
cheating.
going to do what George Bush talked about, fuzzy math. We're not going to do
No,
that.
we're not going to do the fuzzy math. We're not going to do the fuzzy math. And we want to just really take a look at these 25 stocks from a technical perspective, as well as a fundamental perspective and you and I are the ones who finalize this list, right? We know these stocks in and out.
Sure. Yeah.
I still remember why you told me to add Boston Science to the list. You said to me, Tim, we were whittling down the list, and Boston Science made the final cut. And you and I were just debating back and forth, right? And we were debating Tesla, AMD, Boston Science, and there are like 5 or 10 stocks that we were debating for two slots on the list, right? And I remember you saying to me in regards to Tesla, you said, Matt, do you really want to be the one that pulls Tesla off your list when you love Elon Musk? And I said, you're an ass. No, I don't. And I said, well, what about Boston? And you said, Matt, I watched an episode of Black Mirror, and there's this robotic dog, and it scared the dickens out of me. And so we got to add Boston Science to the list. And that was not the complete logic. We were just doing tiebreakers at the time. They were good stocks, good covered call stocks. And you know what? We just want to go through this list to kind of update our listeners and our students kind of what we're seeing on the list. So the first stock, Tim, we're going to look at is, and we're going to go through this down the list from a sector perspective. So we're going to look at the basic material stocks first, and then we're going to kind of go through those sectors by sectors. Now, the first stock on the list is a stock called Freeport-mcmoran. They're a copper mining company out of the basic materials sector. We love commodities in general. We love commodities in general. We used to have an ETF on the list called GDX. GDX is an ETF with all the miners in that. But what we didn't want to do was kind of cheat and have ETFs on our stock list, because we also have a Tackle 25 ETF list as well. And so we made the decision last year to remove any ETFs, USO, GDX, but we wanted a mining company. The problem was finding a really good mining company at the time. And it was more difficult than either one of us imagined. But we had Freeport really showing good growth. It was showing a high base type situation. You were getting at the time right about 2.9% on the covered call is what you were getting. So we're getting right in that 3% range on the covered call. Anything over 2% is good. It's a cheaper stock. Now, obviously, this year it's been showing some degree of difficulty, as gold has also shown some degree of difficulty with the rising dollar. But from a technical perspective, we're not going to pull something off the list solely because it might go down, right? Now, a couple things I do want to talk about, though, Tim. Has anything changed in Freeport today, 6 months later, than what we were looking at 6 months ago?
No, I mean, it's a victim of market, conditions, and that's going to happen. Yeah. You pick any 25 stocks. I don't care who you are. You could be Warren Buffett. You're going to be wrong on some because you can't predict certain things. Hell, you can't predict most things in the market. All you can do is get probability on your side. So there's nothing necessarily different about this. There's a couple of different data points that I find interesting, though, with Freeport-McMoran. Number one, copper and gold company, so sensitive to the price and commodities, but it's relatively held up. We were talking in the market skyline today about gold being down, but yet here Freeport-Mac is, fairly in the middle where it is. When gold gets some pressure, it's going to have some pressure. The biggest concern for me was the reaction to their earnings just recently.
Yeah, oh yeah, the earnings report right here where it really got kind of beat up on earnings. Recovered after that, though. Got back up above price, kind of sitting back in that middle range. I do want to show you just from a fundamental perspective, coming into this year, 2015, they just showed a tremendous amount of loss. They did a little better in 2016, actually showed a profit in 2017. The PE ratio at the time on Freeport, Tim, was basically 26.22. The PE ratio currently is 13. It still has good valuation from a fundamental perspective, and I'm not seeing anything so far from a fundamental perspective that would get me off this, especially if we're still getting a fairly decent covered call number, and we're still getting right about that 3% on the covered call. And so that to me is still fairly decent, even though price has been going down about 10% to date so far. But if you've been doing covered calls, and this is the one thing I want you to realize, Tim, if you've been doing covered calls for 6 months this year, you should be between 15 and 18% profitable on the covered call, despite being down about 10% on the growth. So there's nothing I'm too concerned about here. So let's move on to the next one on the list. The next one on the list is a company by the name of Valero. Now, Valero is an oil servicing company. It is not an oil drilling company. They are an oil gas integrated company. Valero has been on the list a few other times as well. They were not on the list in 2017, but they were on the list in 2015. They were on the list in 2016. This has been a company we have had on this list for 3 out of the last 4 years. Looking at the chart year to date, I see a tremendous bullish uptrend. I see a great bullish retracement. In fact, Tim, you could swing trade this right here if you wanted to, right?
It's been a wonderful performer. There's no doubt about it. I mean, oil has had volatility. Valero has as well, but every time it's pulled back into one of those pay ranges, it's rallied. You know, you had earnings reports twice now. Pretty decent numbers, from what we've seen. Good reaction from investors as well in a long-term uptrend, sitting on the moving averages. It's been a good play for covered calls.
Definitely good play. Up about 25 to 30% year to date. Covered call coming into this year on the covered call, we're only getting about 2%, so not a ton of cash flow, but you are getting good growth on that. And one of the things that with the covered call is it's really the equation of when do you just simply want to take growth versus getting the cash flow versus getting cash flow and growth. And that's the thing you really got to master over time. For example, if Valero's sitting here at support at 115, 116, and I expect it to continue to go up in this good bullish uptrend, I wouldn't write the covered call on it. I'd wait for it to get back into resistance. Then I would write the covered call. That is why it's a cash flow and growth strategy. PE ratio, when we put it on, was right around 20. It's currently right in that same ballpark at 21. So despite the fact that it's going up in value, the PE ratio is still really good. There's nothing to see here. Great stock, decent covered call. I'm not too concerned about it in any capacity.
Good pay, good. It's liquid, good returns. The returns are still fine at 2.5%. The chart's great.
And here's the kicker on that. If oil gets crushed, like we talked about, the volatility of oil, that doesn't hurt a company like Valero. Valero's not a driller like ExxonMobil or Chevron or Conoco. They're an oil servicing company. They beat to their own drum. And when we were looking at that, coming into the year, you were more bullish on oil than I was coming into the year. And I was concerned about Saudi Arabia and Russia. I was concerned about the U.S. oil production increasing. I was concerned about a potential recession, which would drive oil down historically. I had my concerns, right? But so when we were looking at ExxonMobil, ConocoPhillips, which has been stocks on the list in the past, I think both of us felt like take the debate we were having on oil out of the equation. Let's add a really good company like Valero that beats to their own drum, and it certainly has done that year to date. Now, the next two on the list, we're going to talk in conjunction with one another because they're both basic material companies
and
they're both steel companies. Now, typically, Tim, we're looking at Nucor here, and we're looking at U.S. Steel here. So Nucor 1, U.S. Steel number 2. Now, typically, you and I would not add 2 stocks in the same industry together. We'll add 4 or 5 stocks in the same sector together. But, take the financial sector. We added 3 stocks in the financial sector, and I remember debating this with you quite a bit, where we were looking at all these different money center banks and all these different investment brokerages and all these different credit services. And, it was important for us. We were going to add 3 financial stocks. It was important for us to not add 3 money center banks. I didn't want Bank of America, Goldman Sachs, and JP Morgan on the list. I wanted some diversification in most industry. But, coming into the year, I was really bullish, and this is really kind of the beginning of the year here. So if you're looking at this on US Steel, I was really bullish coming into the year on US Steel. I was extremely bullish on US Steel in 2017. It certainly was one of those mainstays on the list last year. In fact, for growth plus cash flow, I would say US Steel was the #1 stock on the list coming out of 2017. And with all the talk of we're going to put all this money into infrastructure, and we're going to buy steel from U.S. companies and whatnot, that political message has kind of changed this year so far. Instead of focusing on infrastructure, which we really haven't done, we haven't seen a lot of stimulus programs on infrastructure. We've seen talk on it, but we haven't seen execution. But with a lot of the political environment, especially the tariffs and trade talks that have been going on last 6 months, that's actually hurt our steel manufacturers a little bit more than it has benefited with just the rumors of 2017. So, but coming into 2017, we were very bullish on steel in general. And so we looked at Nucor and we looked at US Steel. Now I'm still bullish on these, and I'm still bullish on infrastructure, but I am a little concerned about it. The thing I will tell you about both of these companies, and I have no problem with keeping both of these companies on the list right now, Tim, Nucor is a fundamentally stronger company than US Steel is.
Yeah, and bigger.
And bigger. And if you look at them over the last 3 years, they've shown, from an earnings per share, they've shown growth 3 consecutive years. From a valuation perspective, they're currently sitting at 18. That's Nucor. Nucor coming into the year, stock P ratio was 17.7. It's currently 18.8. Revenues have been showing increases. Net income has been showing increases. Little concerned about earnings per share in 2018, but we had good growth coming into 2018. I put Nucor as a much more fundamentally strong company than United States Steel. It also pays a higher dividend, than U.S. Steel does as well. The difference between U.S. Steel and Nucor is on the covered call. On the covered call on Nucor, we were getting right around 2.5% monthly coming into that from the research and back testing we did. On U.S. Steel, I can tell you for a fact we're getting right around 4% in 2016 and 2017 on U.S. Steel. So you're going to get, and that's pretty par for the course. If it's more volatile, you get higher cash flow. Less volatile, less cash flow. That type of scenario. And we talked about that with the VIX earlier. But you're still getting wonderful credits on both of these companies, and I got no issue with either one of these companies. You're looking at still year to date, U.S. Steel, if we're coming into the very, very beginning of the year, you're literally break even right now from the very beginning of the year.
Well, and that's part of the hard thing about building a list, Matt, is that you have that arbitrary date of January 1 that you got to pick it, but you're picking it for the whole year just kind of to have a watch list and build it for covered calls. Yeah. I like both these picks. Of course, they're going to stay on the list. Nucor, I'm a little bit, more fond of myself personally, but I like Trading X. So it comes down to skill and sophistication. If
U.S. Steel's my favorite cover call. U.S. Steel is by far my favorite cover call.
That's right, but you got to know how to manage it, because that volatility can really be difficult.
It'll rip you right in the face. The reason we took AMD off the list last year and added Applied Materials instead, and we'll talk about this down the road, is because we didn't feel like new traders without the experience who have access to this list, we didn't feel like they could manage the volatility of an advanced micro devices, right? So you're going to have less decisions to make on Nucor than you would US Steel. I'll just tell you that from personal experience. You're going to have less decisions on Nucor versus US Steel, but you're going to get higher cash flow. But I don't see anything in the chart or the fundamentals of either company why would be too concerned coming in to this last 6 months in the year. The next stock on the list was PCG. This is Pacific Gas and Electric Company. Now, this one was debated in just a ton coming into this list.
Sure. Well, what it came down to is we had to have a utility, because covered calls, utilities paying dividends who have conservative type conditions.
Defensive in nature.
The big debate was last fall. We had PCG with forest fires in California that was really literally crippling the company from a short-term perspective. But we looked at it, Matt, and we said, you know what? We expect it to stabilize quite a bit. And if you think about it, that's what it's done. It's had volatility. It's gone from 37 to 47 and back and forth, and it's at a low point right now. But if you just take it from January 1 till now, back and forth, up and down, paying a dividend. Well, they haven't paid a dividend this year, actually, now that I look
No,
at it.
they had to take away the dividend because of the forest fires, but you're still getting good cash flow on it, though. I mean, outside of all the and it was the only utility stock that had weeklies on it. But what I felt was we had to have a utility company on the list. We had to. Um, and it was very difficult at the time to find a utility stock that paid up over 2% on the covered call. It was extremely difficult for that to find. This is the only stock that had weeklies on it. And at the end of the day, I personally felt like it was an overreaction to the forest fires. I
Mm.
felt it was going to stabilize, and it's went up and it's went down. It's been volatile, right? But for the most part, it has stabilized. It's down less than 10% on the year so far versus last year, where it was down basically 50% in value. The cover call has offset that. You're probably break even on it. I don't regret putting it on the list, and I still don't regret having it on the list. The company should stabilize, but because we were looking at very limited options from a quality utility company perspective, and I'm not saying there weren't great utility companies, but to fit the parameters that we had decided to create this list, this was really one of the only companies that we could go to. And
Yep.
so that's kind of why we did it. And, I don't regret it, and I don't regret it right now. So let's just move on. The next stocks on the list, three financial companies, Tim: PayPal, E-Trade, Bank of America. So let's go ahead and look at PayPal first from a technical price perspective. Coming into the year, you were looking somewhere around the price of PayPal at the very beginning of the year. If I can get this accurate,
75-ish.
it's about 70. It was about 74, actually. It's currently right at 85. So you've had about a 12%, 13% increase in value. Really kind of just been neutral on the year so far, though. And this kind of goes back to when you pick it versus when you're looking at it. So in terms of this, it's really kind of been neutral on the year from a trend perspective. But I love it, kind of seeing this strength come up into $85. A potential breakout of $85, $86 could be big on PayPal from a directional perspective. There's nothing in the stock I'm seeing from a fundamental perspective. Like I said, we saw increased. If you look at this over the last 4 years, we've seen increased in earnings per share every single year, even though it wasn't tremendous growth. You're seeing increases in revenues, increases in net income, increases in earnings per share. Its PE ratio right now on PayPal is about 49, which is higher than what it was when we were coming into the year. So that is a slight concern for us, that we do have a 49 PE ratio versus what it was coming into the year. So it has shown it is a little bit more overvalued because price is up more than 13% and earnings has not increased that dramatically. So it's a little overvalued, a little concerned, but we've seen stocks stay overvalued for a very long time. That's nothing that I'm going to shake an eye at, Tim. Looking at the next one here, we got
Well, first of all, let me
Yeah,
say
go ahead.
this. PayPal is the exact reason why we make the list. I mean, it's fundamentals are great. Liquidity is
Yeah,
great. It's in the right sector. It's been a good performer. Earnings are growing. Yeah, of course. That one's a no-brainer, and that one actually was a slam dunk. I mean, if you think about, the market has not done much this year. PayPal's at the high points, about to break out and show that much strength in the financial sector. I love it.
yeah,
E-Trade was the big debate between it and Schwab, if anybody remembers.
I remember that one.
E-Trade was a great pick. I mean, look at that stock, Matt. That stock has gone from 50 to 65, 30% gain so far in the
Yeah.
first 2 quarters. Great strength, great trend, good pullback even right now on the chart. What do you see from E-Trade first 6 months?
Great trend, showing a little bit of slowing momentum at the top here, not necessarily bad for cover calls, good cash flow in that. It certainly has done more than I thought it would do. They're going to move in line with one another, but it was really kind of a coin flip situation between Schwab and E-Trade. Those were kind of the two last, if you want to categorize both of these companies as the investment brokerage industry in the financial sector. And those were the last two we kind of looked at. And they were very similar, Tim, from a fundamental perspective. They were similar from a technical perspective. But I think both of us felt like E-Trade was the slightly better company from a fundamental perspective. And we were getting slightly bit of more money on the actual covered call than we were doing on Schwab. So with the quality that it's had this year, is obviously a really good pick coming into the first 6 months. We'll wait and see how it finishes out, but I'm very happy with the pick coming into the first 6 months. And there's nothing I'm seeing from a technical perspective. Certainly looking at the fundamentals coming into the year, you looked at seeing increase in earnings per shares for 3 consecutive years. Your price valuation right now on E-Trade is 23. Coming into the year, Tim, it was 23. So at the very first of the year, we had a 23 PE ratio. Currently, we have a 23 PE ratio, but the price is up 30%, which means their revenues are also increasing. They're making money. They're a fundamentally strong company, and I see no reason to even discuss this any further, because everything looks really, really good so far year to date, both from a fundamental as well as a technical perspective. Now, the next one on the list was your big money center banks, and those big money center banks are like Wells Fargo, Bank of America, JP Morgan Chase, those types of banks. And we ended up choosing Bank of America, and we debated JP Morgan, and we debated that one for about, what, Tim, 1 second, before we said there's no way in
Pretty
the hell
much.
Jamie Dimon's on our list.
Yeah, we just wouldn't support him. So yeah, I
Nope,
know
nope,
pretty
we're not
much.
supporting Jamie Dimon. So that one, Goldman Sachs will never be on any list we ever put out there. Wells Fargo was lying to its consumers, and so it really came down to process of elimination on the more than anything on the money center banks. It came down to process of elimination. And so I don't regret picking Bank of America by no means. You need to have a good bank stock, a big bank stock on a list like the Tackle 25. But when you're looking at it year to date, it had a good bullish uptrend coming into it, high base, broke out, ran neutral, and year to date so far, you're down 1%, right? You're down 1%. You're still getting 2% on the covered call. So if you look at buying the stock at 29, running out at 56, you're getting right at actually about 1.75%. So volatility has kind of shifted on it. You're getting less than 2%. That is concerning for me, Tim, getting less than 2% on the covered call. Coming into the year, growth rates showed consecutive growth, increased in growth from an earnings per share perspective each year over a 4-year time period. It has good revenues. Net income, earnings per share is kind of going sideways right now. PE ratio currently of 14 coming into the year. Let me get what the Bank of America PE ratio was, 17. So it has devalued from an earnings perspective, not so much from a price perspective, Tim. That's a little concerning that the PE ratio has dropped a little bit and price hasn't dropped in response to it. It's showing me a little fundamental concern, a little from a volatility concern. I'm not that concerned from a chart perspective. So that's what we're looking at with Bank of America. The next 2 companies on the list were Biogen and the one we debated, Boston Science, the robotic dogs from Black Mirror. I still have to watch that episode, Tim. Talk to me about Boston Science. What was it? Because Boston Science was really kind of, you were on Boston Science more than I was on Boston
Sure.
Science. And year to date, it's had an absolutely fantastic year. Good call by you on this one, Tim. It's had an absolutely fantastic year coming into the year so far. At the end of 2017, you're looking right about $25 a share. It's currently at $32 a share. That's right about 7 points on 22. You're looking about 30% increase in profitability. It did shoot up last week before it came down, but good trend, good growth. What about this company right now?
Well, I'm a big believer in trading what you believe in, and Boston Scientific makes medical devices that actually help a lot of things in humanity. I know they're a corporation, for-profit corporation, all that kind of stuff, but I'm much more likely to support a company that I think is doing good work.
Absolutely.
And they do a lot of great stuff. I like the company. I like the fundamentals behind the company. We saw earnings growth. We saw expectation. I wanted to have something in the medical field. I wasn't comfortable with the big pharma companies, so we kind of ended up finding Boston Scientific. And we went through the process of how we pick companies back at the beginning of the year in that first podcast we did, about the Tackle 25. And, we started with a big list, Matt. There were probably 5 or 6 companies I was considering, and we just ended up at Boston Scientific. And it's been a great performer, high PE ratio, high multiple. There's no doubt about it. But
It even had a high one coming into the year.
Yeah.
Coming into the year, it was 41. It's currently 47. But you know what? The the robotic dogs. It played out, right? But you look at it from a fundamental
By the way, they
perspective.
don't make robotic dogs. That was just from that
I
show.
know that was
But
from that show, but they do deal in robotics, right? They do in medical
medical
appliance
devices,
robotics
yeah.
and medical devices and whatnot. We just say robotic dogs because it was funny. But when you're looking at it, was showing a loss from 2014, 2013, 2015, showed a gain in 2016, increased that coming into 2017. Revenue is up, prices up. A lot of times companies show a loss, especially when they spend a tremendous amount of money on research and development like Boston Science does, and go get those robotic dogs. I see no reason to take this off the list. The other healthcare stock we had on the list was a big pharmaceutical company, Biogen. And Biogen, we wanted a pharmaceutical company on the list. We had debated two companies on the list. The first one was Amgen, and then we were looking at Biogen. I had concerns about Biogen, even though it shows tremendous profit. I thought fundamentally speaking, Amgen was a better company than Biogen. It was kind of like the debate we had on Nucor versus U.S. Steel. Nucor, a better company. U.S. Steel got better cash flow. The problem with Amgen and Biogen versus the U.S. Steel and Nucor debate was on Nucor and U.S. Steel, we were getting 2.63 on Nucor on a monthly basis, and we're getting 4% on U.S. Steel from a covered call perspective. But on Amgen, we were only getting like 1.2%. And Biogen, we were getting, I believe the back ends were right around 2.43%. So from a covered call perspective, Amgen just couldn't hold its water, right? Biogen certainly could. Still showing good profitability coming to the list. Valuations right here, 15 on a biotech company coming into the year. It was 16. Revenue is down, earned income is down, earnings per shares is down this year, and shockingly, so is the price down year to date. It opened up the year right here, right about 320. It's currently at 288. It's down about 10% in value year to date. I'm a little concerned about it continuing to come down. And if you get concerned about those things, you don't just jump out. You buy put options, you insure it, you keep renting it out. But those are my concerns coming into this next 6 months.
Well,
Now,
look at today. I mean, that's
yeah,
is an example of why Biogen is a concerning company because they didn't even have news on their company, but a rival
now
drug maker had something come out and
there's so many
stock
variables.
drops 5%. This is a
Yeah.
huge company. It still can move 5% on somebody else's news. That's the sensitivity of using a drug company.
Listen, don't do drugs unless you know how to do them.
That's right.
Right? Don't do drugs. Okay, you only do drugs if you know how to manage them, and that's obviously the biotech companies we're talking about, not real drugs, guys. Don't take it too serious. But now the next two stocks on the list are both what I would call industrial stocks. One is an aerospace and defense company, and that is Boeing. Now, Tim, I believe we did about 1 minute of research on Boeing before we said yes.
I love this company.
Yeah, so do I. Fundamentally speaking, it was down here at about 295. It's currently at 354. It's in a buy zone between two rising moving averages. The technicals are absolutely amazing on this company. Fundamentally, this is a very strong company. Its PE ratio right now is 26. Coming into the year's PE ratio is 27. Price is up $60, Tim, and the PE ratio is actually basically neutral on the year. Revenue's up, net income is up, earnings per share is up, and it's also in a very good position in the current political environment. If we do get our infrastructure spending plans coming into 2018, 2019, 2020, and if we do see an increase in military spending from a budgetary perspective, that should just help this company even more. It has certainly slowed down from the meteoric rise it had in 2017 when all that was just kind of rumors. The same thing we saw with Steel. It has slowed down, but it hasn't stopped it. Still love this company, fundamentally strong company. Nothing left to say on Boeing, one of my favorite companies in the stock market today. The next one was a real estate company, D.H. Horton, Tim. Now, a lot of people don't understand, we stock traders, we invest in real estate too. We just do it in the stock market.
Yep.
D.H. Horton coming into the year was the absolute best performing stock on the list last year. And if you'll look at this, what it did last year, look at that meteoric rise. And the bigger they are, Tim, sometimes the harder they fall, and D.H. Horton has kind of taken it on the chin, and so is housing a little bit this year. You're looking at a downtrend. It has stagnated. It opened the year right here, right around, the price was right around $51. It's currently at $41. You're talking about a 20% decrease in price. That is one of the worst performers on the list this year. If you take it from last year to this year, they're still pretty decent. But it is one of the worst performers from a technical and a price perspective. Fundamentally, D.H. Horton coming into the year had seen increase in valuations, earnings per shares, every single year over the last 5 years. Its PE ratio currently is 14. When it came on the list, it was 18. So as the prices came down, the PE ratios came down. So, it's just sometimes this happens, Tim. Is there anything you're seeing from a fundamental perspective, a technical perspective? And lastly, from a trading perspective, you're getting about $1 on 41. That's right around 2.25% on ROI. Is there anything that you're seeing today versus 6 months ago that gives you any concern?
No, it's a good covered call stock. You had the downtrend earlier in the year, which is what is the risk in a covered call. You buy the underlying asset, you own 100 shares. If the stock drops, that's where you lose money.
Yeah.
And part of your job in the Tackle 25 system is to roll those options, collect more credit, continue to trade it. You got to know how to trade this stuff. But now it's kind of found a range, Matt, for about 3 or 4 months now. Just back and forth, back and forth. You're still getting more than 2% ROI on a monthly basis from cash flow. I like it. I got no problem with it.
I still like it. I'm not too concerned about it. Although, one of the worst performing stocks on the list, still not that concerned about it. Looking at the next stocks on our list, they are all service-based companies and mail and catalog companies, discount variety stores, electronic stores, and major airline, resorts, casinos, specialty retail. These are companies we buy things from, right? Either services or products or goods. These are companies that are very consumer driven companies. And the first company on the list is a company known as the VIPS, V-I-P-S, VIPS, V-I-P-S. And so in looking at the VIPS, Tim, the debate was really VIPS or Amazon was really the debate. Now, let me show you from a growth perspective. Obviously, the VIPS year to date is honestly it was the stocks. The stock price coming into the year on the VIPS was $11.72. It's currently $11.65. Had a really good first 3 months, a really bad second 3 months. It's basically just net neutrality right now, right?
Well, and so much of the risk in China that's going on, these Chinese companies, some of them are doing fine. Baba is going up like crazy. VIPS is not. It just depends on the nature of the sector and what
they're going to be news driven.
Yeah.
Those Chinese companies, they are absolutely going to be news driven, no doubt about that. Now, the VIPS is a catalog and mail order company. Amazon is a catalog and mail order company. We obviously wanted Amazon on the list. That's our intention was to have Amazon on the list, and you guys can kind of see how Amazon has done year to date, 1,200 all the way up to 1,700, just an absolute juggernaut of a company, and everybody knows that. But the problem we had with Amazon on the list was twofold. Number one, it had a 270 PE ratio. It was tremendously overvalued coming into the year, and it is still tremendously overvalued today. But the biggest problem, Tim, was the fact that it was a $1,200 company. And to do the covered call, you need 100 shares. And not a lot of retail traders can afford to do covered calls on Amazon. There's much better ways to play Amazon from a credit spread perspective, no doubt about that. VIPS, on the other hand, was a cheaper stock. It was in the same industry, but coming into the year, it had a PE ratio of 24.5. And so it was a much better valuation. It was a close to a $12 stock, which means you can buy more shares, do more covered calls. It had shown growth fairly consistently for the last 3 years. I'd like to see a higher growth rate than what we've seen, but it was showing profitability. Currently, its PE ratio is 22. It's priced pretty much at the exact same level we put it on. So basically, we're just saying, yeah, it's the same thing. You've been making money on the cash flow. It's been a really good cash flow stock. It's just been really volatile. It's reminded me a lot of AMD. It's reminded me a lot of AMD this year in comparison to AMD in 2017. Very volatile. You shouldn't play the VIPS unless you have a deeper skill set from a trade management perspective. The next stock on the list, Tim, is Target. Target was on the list. We debated Target and Walmart extensively. We couldn't get the cash flow we already talked about on Walmart. What's your read on Target right now?
It's been a great performer. Very proud of this pick. I would do it again in a heartbeat. It's obviously been a good performing stock for a covered call. And why do I say that? Well, it's back and forth. Start of the year, took off, had two of its best weeks were right at the beginning of the year, 66 all the way up to about 78, Matt. Then it pulled back and rallied, pull back and rally, pull back and rally. A lot of back and forth. The earnings report was not received well, recently, but earnings were strong. It just missed expectations on some regards. Nice pullback here, neutral company. The thing about it is you got to watch the cash flow. Obviously, when companies kind of dry up here, you're going to have some things change. As long as it stays above 2%, I like it. Currently, if I'm looking at the 40 delta, Matt, you're about 160. You're about 2.2%.
You're slightly over 2%. If you do the 43 delta, you're right about 2.2%. I like the technicals here. I like the fact that it just broke out. I've talked about this a lot on the podcast in the Skyline. When stocks run into the breakout, and when I mean run, they run from 70 to 80 in a breakout. A lot of times they don't do what this did here. They get a little overextended, they come back down, and they make a deeper run on that second run. And that's what I'm kind of seeing in the chart right here, Tim, is seeing it. Big candles driving down, small candle, Morningstar Doji, big green candle. Look for that to start appreciating. I like that from a current technical condition. Looking at the fundamentals coming into the year, kind of like the VIPs, just kind of stagnating from a fundamental perspective. PE ratio, despite price going up this year, is still really good valuation with revenues increasing, net income increasing. You got a PE ratio of 16 versus a 5-year average of 23. That shows me it can still run on top of the current price of 77.5, with especially a breakout of 80. I got no problem with having Target continually on the list. Best Buy, BBY. Best Buy here coming into the year, just to kind of review here. Best Buy opens the year right here at about $68. There's currently $77. Really, though, price is up a little bit, showing a profit, but a lot of neutrality here, Tim. A lot of neutrality
Which
here.
Which is fine. I've said that a few
there's nothing
times.
wrong with that.
Neutral's fine for covered calls. We don't mind a neutral range-bound stock going up and down when you're doing a covered call. I like the potential for a breakout here, though, Matt, especially on those candles. You're looking at the strength right here. Clear resistance at 80. It's been a pretty good performer. If you think about what was the exact price when we printed the year? About 70?
No, the exact price was right here. If you're looking at the opening price on that day, and that's what we took it at. We put the list out on January 1st of this year to prepare for the opening of the January 2nd. You're looking at right at 68.26 currently. Yeah, it's right about 68. It's currently about 77. So about $9 on 68. So you're talking right about 13, 14, 15% growth so far.
Pretty good. Yeah, yep. Nothing wrong with it. Pays a dividend, retail sector. Retail strength has been there. There's no doubt about it. Delta Airlines. Range-bound stock.
Very range bound. And having airlines on the list was important for us. We've had airlines on the list every year. Delta is now been on the list 2 out of the 4 years. Southwest was on the list 3 out of the 4 years. We removed Southwest from the equation coming into 2018. We've had other airlines, Alaskan Airlines, we've had on the list before, but we felt Delta coming into it from a PE ratio. Delta was currently at 11.23% on a PE ratio coming into the year, so it had really good valuation coming into the year. It was starting to form a bullish uptrend. First part of the year kind of shot up and then just came right back down after earnings, came right back down. We've dealt with negative news in the airlines this year, no doubt about that. And it's really kind of stayed neutral. And there's, like you said on a few of these stocks, neutral is not bad from a fundamental perspective coming into the list, really kind of stagnating fundamentally. Current P ratio is 10. There's really nothing changed this year from when we put it on so far. So I don't regret the decision, and still cash flowing with, you're looking at that 40 delta right there, getting paid about $1.10 on 54. That's right at 2%. So at the low end, but you're still getting it. The next stock on the list, Royal Caribbean.
I could use
Royal Caribbean. I could use Royal Caribbean, but not a lot of other people have had a lot of Royal Caribbean lately. Coming into the year, Tim, the price on the opening price was right at 120. It is currently right at 114, so it's seen just a slight decrease in value, but kind of a bearish downtrend for the most part of the year.
Mm-hmm.
Seeing a little bit of change right here. Little bit of change coming up, seeing a little bit of price action, maybe a potential bullish uptrend is now starting here. So definitely check that out. Keep an eye on that. Fundamentally, it showed, and this is what we kind of saw here. Fundamentally, we saw big increases in earnings per shares from 2015, 2016 to 2017. Both of us really, really liked that. We're seeing a little bit of decrease in revenue this year. That's why price is going down. However, coming into the year, Royal Caribbean had a P ratio of 15. It currently has a P ratio of 15. Valuations still in line, no doubt about that. And then the second best performing stock on the list last year was Alibaba. Alibaba coming into the year was 172. It's 207, seeing really good growth, really good trends. Was really kind of volatile, neutral coming into the year, or coming in, and not coming into the year, but kind of so far this year, but it's had a really good last couple months. Tim, what do you got to say about Alibaba?
I love this company, and the current trend is really, really strong, by the way. That earnings report in May solidified some of it. You can, and part of what you do with a fundamental list, Matt, is you make so many of your decisions around how they operate around the earnings. And for a lot of the companies that we've gone through on this list, we've seen big movement on the earnings. First one there, February for Baba, it dropped it, brought the price down to 170. Then it rallied back with the market, volatility in late March and early April, brought it back down to 165. The earnings in May were incredible, and the company jumped. Big, strong green candles. We're developing an uptrend. We're above the moving averages. Very strong, very bullish. And covered calls, you want bullish or neutral. Those are really the conditions you want.
Yeah.
And I like it. It's been good, a really, really good performer.
Yeah, from a timing perspective, this is a really good cover call right now. If you do own it, it's showing a little bit of slowing momentum. But kind of going back to the discussion, Tim, we had on, one of the tricks you have to kind of perfect here is when to write that cover call. And if I see a strong breakout of 211, Tim, 212,
Mm-hmm.
that thing could appreciate fairly aggressively, and you might not want to write the covered call and just capture the growth if it does break out of that 210 to 211, 212 area. Looking at the fundamentals coming into the year, showed kind of some neutrality here, showed a decrease in 2017. Revenue is up so far in 2018, so it's kind of neutral. The PE ratio coming into the year was 48, which was overvalued, but you were very bullish on Baba. You like this company. I like this company. You love this company. Current P ratio is 52, so it's one of the higher P ratios on the list. But again, that's all based on the market thinking massive growth ahead of Baba. Massive
For
growth
sure.
ahead of Baba. So there's nothing really that we're going to be too caught off by a 52 P ratio. That's not Amazon at 270. You know what I
Sure.
mean?
Yep.
One great earnings report will bring that earnings PE ratio down. Then the last four stocks on the list were all tech stocks, Tim. First one on the list, everybody knows, Microsoft.
It's been a juggernaut too.
It's been an absolute juggernaut.
I really
85
think
up
one
to
of
100.
the understated stories of the year, in my opinion, is the growth and the resurgence of Microsoft. I believe I saw something in the news the other day that Microsoft retook Google in terms of market cap.
Yeah.
It's been
They
great.
had a 10-year stretch where they did nothing.
Yeah.
I mean, they had a 10-year stretch where Microsoft was like, boring. But it's had a great 2017. It's having a great 2018. You're not seeing massive volatility. It's been very, very consistent. Its earnings don't drive the stock crazy one way or the other. They're retooling who Microsoft is coming into the year. So there's nothing here. Coming into the year, you had basically stagnation on earnings per share, but you did see increases for 3 consecutive years. Earnings and revenues are up this year so far to date. Its current PE ratio is 27. Coming into the year, it was 28. So again, it has a cheaper valuation today despite being the higher price. And I want you to think about, Tim, if it has a cheaper valuation today, but it's up 15% on the year so far, that's a positive sign, isn't it?
Yeah, for sure.
Yeah, that's a positive sign. Price is going up So earnings is going up faster than prices going up is basically what that means. And so I like this stock too. You like this stock. The only concern you have in this stock is from a how much are you getting on the covered call, and you're actually coming into the year coming on the covered call, you're getting about 1.915%. If I sell this 44 delta right now and I collect $2.15 and I buy the stock at 100, that means I'm cash flowing 2.15%, which means despite it going up, despite the market volatility at the low, you're actually getting a higher ROI on the cover call today than we were getting when we were doing the research in December on Microsoft. All positive signs. There's nothing, I mean, it would have to take a huge act of something for us to remove this stock, even if it does come back down in value a little bit. It's a good covered call stock. It also pays a fairly decent dividend, and you don't have to deal with the volatility of it. The next stock on the list is Facebook. Now, Facebook also one of those juggernauts of stocks. This year so far to date, Tim, Facebook opened at 177, is currently 199. So it's up about 20 points. It's up about 10% on the year. But man, oh man, oh man, oh man, have you had to deal with some massive volatility shifts on Facebook, Tim?
Sure. Well, you've had to do a lot of management if you've been in Facebook this year with the Cambridge Analytica scandal, Zuckerberg in front of every governing body around the world, in the European Union, Congress, you name it, trying to justify it. Concerns from Wall Street on what's going to happen. But then the Facebook warriors, like you called them earlier, still going on to Facebook, and the
They
revenues have
don't
been
care.
strong. The
Facebook
earning,
consumers have proven, Tim, they don't care if Facebook is sharing their private information. Some of us do, but there's 2 billion users and they're
yeah.
still putting pictures of cats and food and blah, blah, blah on Facebook. And the revenues, they make more money than anybody not named
Well,
Apple.
look at that earnings. I mean, the earnings came out after all of the scandal stuff, and then boom, they beat the number, they beat the expectations, they gapped up $15. They ran. They're now in a beautiful uptrend. They're one of the reasons why the market has been strong in the last month too,
Yeah.
especially in the tech sector. It's been a great pick. The volatility notwithstanding, and that's part of trading. I mean,
Hey,
that is the
listen,
nature of the
the
game.
institutions who own Facebook, when they came out with that earnings, they said, hey, listen, guys, we just made $10 billion for you guys. And we don't have very much cost because we don't produce our own content. So yes, they're saying some bad things about us politically, and yes, there is some negative information. And yes, Zuck's reputation has certainly gotten a hit. But you know what? They still made $10 billion without any cost because they don't create their own content. You can't get away from that. There's no doubt about that. Facebook coming into the year, 32.8 PE ratio. Current PE ratio is actually down despite the stock being up. It's 28. Revenues have been fairly consistent. Big growth. This is absolutely a massive growth company. It has a massive growth ahead of it. There's obviously political risk. There's obviously, from that perspective. But Tim, let's say we go through a recession and people don't have a job and they need somewhere to bitch and moan. They're going to go to Facebook. And Facebook's going to make money, and that's what this company is. It's a juggernaut. There's no doubt about it. It's just been really, really difficult to trade this year. It's been really difficult to analyze this year. It's been difficult with the covered call this year, but it is up year to date. Its fundamentals are still strong, and and it's got tons of liquidity in the options market, and you're still cash flowing right about 1.8% right now on Facebook. So I'm a little concerned with the covered call perspective. This is more of a growth than a covered call. But the last two stocks on our list, both semiconductor companies, one is semiconductor broadline, that is Intel, and the last one is Applied Materials, Tim. Applied Materials is a technology semiconductor equipment company. Intel first, though. Intel on the year to date, Intel opened up the year at 46.38. It's currently at 53.18. So we've seen a little bit of price appreciation on Intel. Its fundamentals coming into the year, we're seeing basically stagnation from 2013 through 2016. Showed a big bump in 2017. Revenues are up year to date. PE ratio is 16 right now. Intel's PE ratio last year was also 16. Not as lot has really changed outside of the strength of the trend. The trend has shown some strength outside of that. So really nothing to say on Intel. But Tim, you one of your picks coming into the year was Applied Materials. Real volatile so far year to date. Opening price on the book year to date was 51.68. It's currently at 48. So we're really kind of looking at neutrality so far on Applied Materials. But the one thing I will say, Tim, coming into the year, and one thing you kind of were like, Matt, this company is a fundamentally very strong company. And we were debating the difference between Applied Materials and AMD at the time. And AMD was not making money. AMD was extremely volatile. And you said, Matt, look at applied materials. It went from earnings per share of 21 cents to 87 cents to $1.12 to $1.54, and then a huge jump to 317. Revenues so far year to date are still up. PE ratio is at a 12. It was at a 16 coming into the year. Valuations are still fairly decent. Now, you felt this company was a very strong fundamental company, and the numbers certainly justify that. Is there anything you're seeing from a price perspective, fundamental perspective, volatility perspective, or covered call perspective that gives you any concern?
Yeah, inconsistency in the first few months, obviously, as it's rattled back and forth. It's generally neutral over time. The big rallies and the big sell-offs can be difficult to manage, though. But that's
Extremely.
kind of why we were cautious about AMD to begin with. That's what we saw in 2017 with AMD. AMAT is now not exactly that extreme, but it is doing some back and forth action. This support level for a covered call trader, it is a concern here at 47 and a half, 47 range. This has to hold for you. If you're going to play covered calls, it's
Yeah,
in a
no doubt.
downtrend. If you're in long on AMAT right now, you're watching these levels at the lows with real, consideration, maybe adding a put option, collaring that trade, hedging it, whatever you need to do.
Well, you look at this, Tim. You got a horizontal support level right here at $48 is where your support level is. You have decreasing resistance levels, horizontal support levels. That is a bearish descending triangle pattern. If it breaks out of that 48 level, if you're a long-term investor in applied materials, you're not going to get out of that, but you might be wise to cover that by buying put options
Sure.
on the stock. Tim, in putting these lists together over the last 4 years, and it was really good to go over this with you today, and I really hope that the listeners have got an insight in how we approach these lists in terms of creating, debating them, putting them together, looking at the technicals, the fundamentals, the volatility, the open interest, the volume, the from a cover call perspective, dividend perspective. There's a lot that goes into these types of things, and we certainly know that people look forward to what we put out there. From watch list perspective, and we do take great care in putting the research into these things. There's a few stocks I'm concerned about right now,
Mm-hmm.
but for the most part, the 25 has been fairly consistent. It's beat the market so far year to date. If you do average growth, it's and that's been consistent really since 2015.
Well, yeah, one of my favorite things about the list, Matt, is the whole purpose of a watch list to begin with. With 25 companies, I can pick my favorite 5 or 10, and kind of trade those on any given month,
Yeah.
based on conditions, based on timing, based on whether or not the covered call is paying out right then or not. It's a really, really valuable system for me. And I know it's a really valuable system for any trader out there that wants to learn how to trade covered calls, naked puts, work from a watch list. There's a lot of consideration that goes into it. There are some stocks that, obviously have not been the best to manage. The volatility can be concerning, but outside of that, I think we've done a really good job, and I'm excited about the back half of the year. We'll see how that thing shakes out as well. Remember, when we build the Tackle 25, it's for the whole year,
Yeah.
and so it's designed as a watch list to trade off of options and different opportunities with. So
Yeah, we don't put $100,000 equal weighted in 25 stocks. No, we pick the ones we like.
that's
Of
right.
the 25 stocks, there's probably 15 of the stocks on the list that I really really enjoy doing, that I really like. And I never do 15 cover calls in a monthly basis. Like my zone is 5 to 8 is kind of where my zone is. And so it's just like any other watch list. It's there to generate